After a favorable reaction to the monthly labor report, it's logical to ask, are stocks poised to rocket higher? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. These are the major bull-bear points that we covered last week. With a strong labor report, at least relative to the headline number, this narrative carried the day on Friday. If you've been working on Wall Street for the last 20 years or so, on a day like Friday, you might have expected hybrid and defensive assets to get killed and risk-oriented assets to significantly outperform. The narrative that we talked about last week, somewhat of a split look where we have hybrid or defensive growth participating and leading alongside growth-oriented ETFs. That narrative still held in the past 5 days, and it even held on Friday. For example, all of the positions held by the CCM market model, and many of them fall into the hybrid category. All of them made money over the past 5 trading sessions, and all of them were green on Friday following the labor report. Kathy and I started in the markets back in the mid-90s. If you were working on Wall Street in this period here from, let's say, 1995 to 2000, you remember that risk on looked quite a bit different during this period here than it does today. Typically, weak dollar assets would lead during risk on. So when you came off a low, XLE, XLB, energy materials, small caps, higher beta type ETFs would lead. One of the reasons for that is credit growth. Credit growth during this period was strong. Look at the slope of this line here. 9% annualized. Credit growth has slowed, and the market is noticing that. This chart comes from Janus Capital Group, and this text here from Bill Gross's monthly investment outlook. As Bill Gross noted, earlier in the century, annualized credit growth averaged 9% a year. Now we've fallen into a period where it's less than half of that, roughly 4% annualized. When we're in a highly levered economic system and credit growth starts to wane, we get suboptimal growth, which means somewhat tepid but positive GDP numbers. As Gross points out, when the private system, meaning banks, not central bankers, fails to generate sufficient credit growth, then real economic growth stalls and even goes in reverse. You can see this line here is similar to the stall in the stock market that we've seen over the past 2 years or so. Therefore, waning credit growth, and maybe more importantly, the impact on economic activity around the globe, are 2 additional reasons why investors have been skeptical as stocks have moved higher, and there are 2 additional reasons to account for the positive performance of hybrids in 2016. One of the easiest ways to see the impact of slowing credit growth and somewhat of a shift in ETF leadership is to look at an updated version of the daily materials relative to defensive treasuries chart. Think about how far the stock market has moved since the Brexit lows. Look at the ratio here. It's really not that far away from a multi-month low here. Typically, when you get a rally like the one we've seen off of the Brexit low, in the old days, materials probably would have smoked TLT. If we take a step back and look at the weekly chart, on Friday afternoon, XLB for the week was lagging TLT by over 1%. We showed this chart 3 weeks ago, and we said that the ratio peaked 9 weeks ago. Well, now it's 12 weeks ago. This is somewhat of the peak in the inflation trade on a weekly basis. This is April. Look where we are now. This is not a particularly confidence-inspiring move off the low. That doesn't mean the S&P 500 can't go higher. It just tells us the XLBs and the XLEs and the XOPs might not be the best place to be if stocks take another leg up. Obviously, if a ratio like this can break out and improve, the observable evidence would change. But the evidence that we have in hand right now is not particularly favorable for inflation-oriented or inflation-friendly ETFs. This is energy, Friday afternoon, July 8th. You can see it has also failed to break out in any meaningful way. Obviously, that might change, but it does have somewhat of a waning momentum look over the past few weeks. Thus, when our weekly tips are Treasury inflation-protected bonds relative to standard IEF, when we get a downtrend like this, in an environment where the U.S. economic data is still holding up relatively well within the context of slowing credit growth, we tend to get that mixed look here, and we tend to see some of these hybrid ETFs actually outperform the old school risk-on ETFs. A concept that's very easy to see when we compare the S&P 500, which is now knocking on the door of this 2134 level. If we take the exact same time frame from a calendar perspective and look at the performance of the S&P 500 relative to bonds, it paints a different picture. The XLE and XLBs of the world may take on a leadership role if this ratio can break out above this orange line. This look here is not necessarily bearish for the S&P 500 as long as the economic data holds up. Brexit remains relatively tame, and central bankers around the globe continue with their hyper-dovish stance. All of those bullet points are subject to change, but they have not changed yet. The S&P 500 index is a daily chart. This is Friday, payroll Friday at 11:49 a.m. Eastern. You can see right here, we're bumping right up against an area that has acted as resistance in the past. If we fast forward and switch over to candlesticks at 4 p.m. on the same day, you can see we closed above what had previously acted as resistance. If we zoom in, we can see, unlike some of these candles here and here and even here, this is a relatively good-looking candle. In fact, all of these candles, this one, this one, this one, this one, and this one, all show strong buying power. We've also talked about volume and market breadth drying up as we approached potential resistance. Friday's move was a little bit different. Market breadth, which really speaks to the number of stocks participating in the rally, was outstanding on Friday. This is different. This is something different than what we've seen in the past when we've tried to break out. NYSE volume on Friday, 94% of it was associated with positive issues, 88% on the NASDAQ. And in recent videos, we've shown that SPY volume has tended to dry up on rally days. Friday's rally occurred on above average SPY volume. Doesn't mean the stock market's out of the woods. It just tells us that this breakout attempt probably has a higher probability of succeeding than the previous breakout attempts that actually did fail. Only time will tell, and we're still near that area of potential resistance, and we know that we've seen numerous false breakouts and false breakdowns over the past 2 years, but there were some encouraging signs during Friday's session. This is NYSE, the broad NYSE weekly closing prices only. This week, we were able to close above this level for the first time since the summer of 2015. That's observable. We can see it from an implementation rule or if-then rule perspective. We cleared a hurdle that we could not clear in the past. You can also see observable evidence here. We closed with a breakout and a full-bore bullish look. Checking in on our long-term fibs. somewhat of a mixed bag here. From a positive perspective with the fibs, we were able to close above the 61.8% level. We have done that in the past. We were just unable to hold it. However, if we look at high-low closing prices on a weekly chart, previous resistance here, resistance again here. So there are still some hurdles to clear, but we have seen some mathematical improvement. If we're looking for a chart or some data that can help us with an open mind about a reversal and the bearish case, let's update this chart. Let's look at this chart, the same time frame from a calendar perspective. This is stocks. Now let's look at stocks divided by bonds. This looks pretty impressive here coming off of this 2016 low. But if we add in bonds, the same NYSE chart takes on a radically different look. Something else that was important this week. While price and volume were able to do some impressive things, over the last 5 trading sessions, the broad NYSE Composite Stock Index lagged defensive bonds by a wide margin, 1.59%. The last thing this chart did was make a lower low. It's important that we realize what we're looking at here. What this is showing us is since mid-April, despite the stock market's impressive gains, bonds have outperformed stocks. That's not necessarily bearish for the stock market, but it tells us, based on the evidence that we have in hand, having some hybrids in our portfolio makes sense. The math and the observable evidence can help us discern between this mixed look in leadership that we've been talking about for the past few weeks. We just looked at a chart that shows that bonds have been outperforming stocks. Well, what about the inflation trade or the economic strength trade relative to stocks? This is oil stocks relative to the S&P 500. It stalled here in April of this year. It's consolidating. You can make an argument that it could push higher, but it hasn't pushed higher yet. This type of chart, as it stands now with this waning momentum, favors a broad SPY over an XOP. Only the stock market knows why defensive-oriented bonds outperformed stocks over the past 5 trading sessions and why bonds have been outperforming since mid-April. However, it's highly unlikely that the Brexit story is out of the news. Here's the Brexit vote decline here, a plunge, a plunge. The rebound in European financial stocks has been very, very tepid relative to the rebound in the S&P 500. So this is significant underperformance, telling us that the markets still have some concerns about banks in Europe. Can we find any other evidence in the market that supports these bullet points? A, that interest rates will remain low, and B, that the U.S. economy will avoid a recession. In the short run, the answer is yes. On Friday, home builders were up roughly 2.5%. This is a nice move here. Common sense tells us that if interest rates are low, that's good for people that want to own homes, so it's good for home builders. It's easier to buy a house when you can get a low rate on your mortgage. Also, if we're going to go into a recession, it becomes harder to get a loan and buy a house. So if home builders are holding up well, that speaks to expectations about the economy and interest rates. This chart also shows us how difficult the markets have been and how confused they've been. August of last year, this is a bullish move here, a false bullish move that was retraced. Here we get somewhat of a breakout in this area here. That was retraced. Then we came up to resistance here. We got a bullish breakout, more confusion, a failed bullish breakout, a second bullish breakout, and another failed bullish breakout. We don't know if this move off of the low here is any different than these moves here. What we do know is the short-term trend on this chart favors improved economic outcomes or avoiding a recession and low interest rates. Obviously, that might change again. There definitely were some good signs on Friday. However, the market still has some work to do. You can see we're basically in the same area that we've been in the broad NYSE Composite Daily on Friday, July 8th. If we look at closing prices, it paints a similar, we still have hurdles to clear picture. Another example of observable improvement are hurdles being cleared that were not cleared in the past. Resistance. On Friday, we broke above the blue trend line, and remember that it came on strong volume in the SPY world and was accompanied by impressive market breadth. Whether or not this holds remains to be seen. We've seen numerous false breakdowns and false breakouts. Is it possible that this is a false breakout on this shorter term chart? Absolutely, positively, yes, it's possible. Right now, that doesn't discount the fact that this looks better than this period here or here. Global stocks weekly ACWI in the ETF world. Impressive move here and another impressive move this week. We're still near potential resistance. The bulls would like to see ACWI make a visit into this white space here and stay there for an extended period of time. This chart is showing improvement and some positive signs. However, if we take ACWI and divide it by bonds, this impressive rally off of the February 2016 low looks quite a bit less impressive. Here's your rally, and now we've retraced a good bit of this rally. If you want to be an optimist here, you can make an argument that maybe we're making a higher low relative to this low here. However, right now we have a clear and discernible downtrend in favor of TLT relative to ACWI. That may change, but it hasn't changed yet. And that's not necessarily bearish for ACWI, but it does tell us to keep an open mind about bearish outcomes in the future. Global Stocks Daily FTSE All World Index. This is an impressive move here, but it's still a lower high relative to this high, and this high is a lower high relative to this high. Like the previous chart, the bulls would like to see this index park itself in this white space here. That has not happened yet, and momentum also has somewhat of a waning look to it. This chart still has some work to do. Very similar situation here. If we look at materials in isolation, nice move on Friday, somewhat of a waning momentum look and some work to do. Thus far, REITs are holding this bullish breakout here. This is VNQ weekly as of July 8th. Low beta, high beta, waning momentum. From a glass half full perspective, this low here right now is higher than the February low here. Similar narrative here, some improvement, but a lot of work to do. This is RSP, an equal weight S&P 500 ETF relative to TLT. This is the Brexit drop. Notice the retracement here from a bullish perspective. So far, not very impressive, and momentum is waning as well. Tech stocks, the triple Qs. These are some nice looking candles here. We're making a third attempt to clear the New Year gap here. This is the beginning of the year, the gap down. We'll learn something either way. From a positive perspective, the triple Qs on Friday, July 8th at 1 p.m. we're trying to clear this downward sloping trend line. IYT in the ETF world weekly has some work to do, has been unable thus far to clear the A to B fibs shown here. Gold mining stocks, GDX, had a nice follow-through weekly candle relative to the candle that we covered last week. GDX tacked on 5.13% over the past 5 trading sessions. Similar situation with SLV or silver. Bullish breakout here. Not a bad looking candle over the past 5 sessions. SLV tacked on 2.56%. One of the great things about having chart lists that you can add annotations to is you can make notes. Here was a note here made in April. Noteworthy if RSI can get above orange and green lines. That's all the way back in April. Thus far, RSI has been unable to clear the orange and the green lines. And this RSI is for the weekly risk-on, risk-off chart, which is the S&P 500 relative to a diversified basket of bonds. This chart, the weekly chart, is as of Friday, July 8th at 1:07 p.m. after the release of NFP at 8:30 the same morning. Another broad stock index weekly, Wilshire 5,000, resistance in this general area. We were able to clear the downward sloping orange trend line this week with a relatively good-looking candle following this good-looking candle. It's a mixed bag, however. We have not cleared weekly resistance here, the blue line, weekly resistance here. We're challenging that resistance, and we should learn something either way next week. I believe in the past we have noted this potentially bullish RSI divergence on the weekly chart. When we head into next week, we will still be near those long-term inflection points. However, the short-term bias is tipping in this direction. However, these bullet points are still relevant. Therefore, we'll head into next week knowing that charts like this and charts like this, the hard data, the model, the risk-on, risk-off ratios, and the rules will help us get in the right place from a long-term perspective as these assets battle it out. But that can only happen if we keep that always important, flexible, unbiased, and open mind. And that includes being open to bullish outcomes for stocks, even in the context of a chart like this, where hybrid assets are holding up and performing well at the same time. The market will sort it out over time, and most likely there will be a winner on this side of the equation or on this side of the equation. The answer right now is clear. We have a downward sloping trend line here that favors TLT over the S&P 500. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.